What if I told you that right now, as you're watching this, 90% of traders are losing money with the exact same strategies that could make you profitable? The difference isn't in the charts, the indicators, or even the market conditions. It's happening between your ears. And in the next few minutes, I'm going to show you exactly how to flip that switch. Welcome to this deep dive into advanced trading psychology, where we'll explore the mental skills that separate elite traders from the rest. If you're here, you already know that trading success isn't just about charts and indicators. It's about mastering the 6 inches between your ears, the psychological foundation of trading success. Let me share a truth that took me years to fully grasp. You can have the best strategy in the world, but without psychological mastery, you'll still fail. Studies show that 80 to 90% of trading success comes from psychology, not technical analysis. Think about it. Every trader has access to the same charts, the same indicators, the same market data, yet only a small percentage consistently profit. Why? The difference lies in how they think, how they manage emotions, and how they execute under pressure. Trading psychology isn't about positive thinking or motivational quotes. It's a systematic approach to understanding and optimizing your mental processes for peak performance. Just as athletes train their bodies, traders must train their minds. Consider Paul Tudor Jones, one of the greatest traders of all time. He once said, "The secret to being successful from a trading perspective is to have an indefatigable and an undying and unquenchable thirst for information and knowledge." But here's what he didn't explicitly say: that thirst must be coupled with emotional control. In my early trading days, I had all the technical knowledge. I could spot patterns, understand market structure, and execute complex strategies. Yet I was losing money consistently. The turning point came when I realized my enemy wasn't the market. It was my own psychology. Fear made me exit winning trades too early. Greed made me hold losers too long. Overconfidence led to oversized positions. This video isn't just theory. We'll cover practical techniques you can implement immediately. From managing fear and greed to building unshakable discipline, from overcoming cognitive biases to developing mental resilience. Each section builds on the previous, creating a comprehensive framework for psychological mastery. Trading psychology encompasses several key areas: emotional regulation, managing fear, greed, hope, and frustration; cognitive clarity, overcoming biases and thinking errors; behavioral consistency, executing your plan regardless of feelings; mental resilience, bouncing back from losses and drawdowns; peak performance, optimizing your mental state for trading. Mark Douglas, author of Trading in the Zone, revolutionized how we think about trading psychology. He taught that consistency is a mindset, not a strategy. This fundamental shift in perspective transforms how you approach markets. Think of your mind as your trading operating system. Just as you'd update your computer software for better performance, you must upgrade your mental software. Old programming based on fear, scarcity, or get-rich-quick mentalities will sabotage even the best strategies. The market is neutral. It doesn't care about your opinions, hopes, or fears. It simply reflects collective human behavior. Your job isn't to fight the market, but to align your psychology with market reality. This requires brutal honesty about your mental strengths and weaknesses. Throughout this video, we'll reference real traders who've mastered their psychology. From Jesse Livermore's lessons on emotional control to Ray Dalio's principles-based approach, from Linda Raschke's discipline to Tom Baldwin's mental preparation techniques. Their stories provide roadmaps for your own journey. Remember, trading is one of the most psychologically challenging professions. You're making decisions under uncertainty, with real money at stake, often in isolation. This creates a perfect storm for psychological challenges, but with the right mental tools, these challenges become opportunities for growth. By the end of this video, you'll have a comprehensive toolkit for psychological mastery, but knowledge without application is worthless. I challenge you to implement at least one technique from each section, tracking your results. Notice the difference. Psychology isn't a one-time fix, it's an ongoing practice. Mastering emotional control in trading. Let's dive into the emotional landscape of trading. Every trader, regardless of experience, faces four primary emotions: fear, greed, hope, and regret. These aren't character flaws, they're evolutionary responses that helped our ancestors survive, but in trading, they often work against us. Fear manifests in multiple ways. Fear of losing money causes premature exits from winning trades. Fear of missing out, or FOMO, drives impulsive entries. Fear of being wrong prevents traders from taking valid setups. I once worked with a trader who'd identified a perfect setup but couldn't pull the trigger. His fear of loss paralyzed him. The trade went on to hit all targets without him. The regret from missing that trade created more fear, starting a vicious cycle. To manage fear, we must first understand its root. Fear in trading usually stems from trading with money you can't afford to lose, lack of confidence in your strategy, previous traumatic losses, unrealistic expectations about win rates, attaching self-worth to trading results. Here's a practical fear management technique I call the worst-case scenario exercise. Before entering any trade, ask yourself, what's the absolute worst that can happen? Usually, it's losing your predetermined stop-loss amount. If you can't emotionally accept that loss, reduce your position size until you can. This simple exercise removes fear's power by making the unknown known. Greed is fear's evil twin. It makes traders hold winning positions too long, hoping for just a bit more profit. It drives over-leveraging and abandoning risk management rules. Greed whispers, "This time is different. This trade will make you rich." I've seen greed destroy more accounts than any other emotion. A trader turns a 50% gain into a 20% loss because they couldn't take profits at their target. They watch their unrealized gains evaporate, paralyzed by the hope of more. The antidote to greed is systematic profit-taking. Set your targets before entering the trade and stick to them. Use the scale-out method. Take partial profits at predetermined levels. This satisfies greed's desire for more while protecting gains. Let me share a technique from legendary trader Jesse Livermore. He'd mentally pay himself after each winning trade by physically moving profits to a separate account. This created psychological separation between trading capital and earned profits. Try this. After each winning week, transfer 10% of profits out of your trading account. Watch how this simple act reduces greed's influence. Hope is perhaps the most dangerous emotion in trading. Hope makes traders hold losing positions, praying for a reversal. Hope ignores stop losses. Hope turns traders into gamblers. As the saying goes, hope is not a strategy. The market doesn't care about your hopes. When a trade goes against you, hoping it reverses is like hoping gravity stops working. Professional traders cut losses quickly because they understand this truth. Replace hope with acceptance. Accept that losses are part of trading. Accept that not every trade will work. Accept that protecting capital is more important than being right. This shift from hope to acceptance is transformational. Regret is the emotion that lingers after the trade. Regret over missed opportunities, over losses, over imperfect executions. Regret keeps traders stuck in the past instead of focused on the present. Here's a powerful reframe. Every trading decision provides data. Win or lose, you're gathering information about markets and yourself. Instead of regret, practice curious analysis. Ask, what can I learn from this experience? This transforms regret into education. Let's discuss practical emotional control techniques you can implement immediately. The 10-second rule. Before entering or exiting any trade, pause for 10 seconds. Take 3 deep breaths. Ask yourself, am I acting from emotion or from my plan? This simple pause can prevent countless emotional mistakes. Emotional check-ins. Set hourly alarms during trading hours. When they ring, rate your emotional state from 1 to 10. If you're above 7, highly emotional, step away from the screens. Trade only when you're between 3 and 6, alert but calm. The trading mantra: develop a personal mantra that grounds you. Something like, I follow my plan, I trust my process, I accept all outcomes. Repeat this before each trading session and during emotional moments. Emotional control isn't about becoming emotionless. It's about acknowledging emotions without being controlled by them. Think of emotions as weather. You can't stop storms, but you can choose not to sail in them. Dr. Brett Steenbarger, a leading trading psychologist, teaches that emotions are information. Fear might signal you're oversized. Greed might indicate you're chasing performance. Hope might mean you're fighting the trend. Learn to read these emotional signals. Professional traders develop what I call emotional flexibility. They can feel fear without panicking, experience greed without acting on it, have hope without depending on it. This flexibility comes from practice and self-awareness. Here's an advanced technique: emotional rehearsal. Before the market opens, mentally rehearse different scenarios. Imagine your positions going against you. How will you respond? Imagine a massive winning trade. Will you stick to your targets? This mental preparation reduces emotional surprises. Remember, the market is a mirror. It reflects your internal state. If you're fearful, you'll see danger everywhere. If you're greedy, every move looks like an opportunity. Master your emotions, and you'll see the market more clearly. Conquering cognitive biases in trading. Now let's explore the invisible forces that sabotage trading decisions: cognitive biases. These mental shortcuts helped our ancestors survive, but often mislead us in modern markets. Understanding and overcoming these biases is crucial for consistent profitability. Confirmation bias tops the list of trading psychology killers. It's our tendency to seek information that confirms our existing beliefs while ignoring contradictory evidence. A bullish trader sees bullish signals everywhere. A bearish trader interprets every data point as bearish. I once mentored a trader convinced that tech stocks only go up. He'd cherry-pick positive news while dismissing negative reports as temporary noise. This bias cost him significantly during the tech correction. He literally couldn't see the bearish signals that were obvious to neutral observers. To combat confirmation bias, practice active disconfirmation. For every trade thesis, spend equal time looking for evidence against it. Create 2 columns: why this trade will work and why this trade will fail. If you can't find strong points for both columns, you're likely biased. Here's a powerful exercise: the Devil's Advocate Journal. After developing a trade idea, write a paragraph arguing the opposite position. Pretend you're a trader who needs to take the other side. What would they see that you're missing? This practice reveals blind spots. Anchoring bias occurs when we rely too heavily on the first piece of information we receive. In trading, this often manifests as fixation on entry prices. I bought at 100, so it must go back to 100. The market doesn't care about your entry price. Professional traders use a technique called price amnesia. Once in a position, they forget their entry price and evaluate the trade based on current conditions. Ask yourself, if I didn't own this position, would I buy it here? If the answer is no, consider exiting regardless of profit or loss. Loss aversion makes losses feel twice as painful as equivalent gains feel good. This bias leads to holding losers too long and cutting winners too short, the exact opposite of profitable trading. Traders become risk-seeking with losses, hoping to break even, and risk-averse with gains, fearing to give back profits. The solution is predetermined exit planning. Before entering any trade, define both stop loss and profit targets. Treat these as contracts with yourself. Breaking these contracts should feel more painful than any individual loss. Recency bias overweights recent events in our decision making. After a winning streak, traders feel invincible. After losses, they become overly cautious. Both responses ignore the larger statistical picture. Combat recency bias with rolling performance analysis. Don't evaluate your trading based on the last few trades. Look at 20 trade, 50 trade, and 100 trade rolling windows. This broader perspective prevents recent results from distorting your confidence. Hindsight bias makes past events seem more predictable than they were. I knew that stock would crash, or I should have seen that rally coming. This bias prevents real learning by creating false memories of predictability. The antidote is real-time documentation. Record your analysis and predictions before events unfold. Include your confidence level, 1 to 10, for each prediction. Review these records monthly. You'll be surprised how uncertain you actually were about obvious moves. Availability bias makes us overestimate the probability of events we can easily recall. If you recently experienced a flash crash, you might overestimate crash probability. If your friend made money on meme stocks, you might overestimate their potential. Counter this with statistical grounding. Keep a database of actual market statistics. How often do 10% crashes occur? What percentage of IPOs actually moon? Let data, not memorable anecdotes, guide your probability assessments. Overconfidence bias might be the most dangerous for successful traders. After a winning streak, traders often increase position sizes, abandon rules, or trade outside their expertise. The market has a way of humbling overconfident traders. Paul Tudor Jones combats overconfidence by assuming he's wrong until proven right. He said, "I believe the very best money is made at the market turns. Everyone says you get killed trying to pick tops and bottoms, and you make all your money by playing the trend in the middle. Well, for 12 years, I have been missing the meat in the middle, but I have made a lot of money at tops and bottoms." Implement confidence calibration. Rate your confidence for each trade, 1 to 10. Track whether higher confidence correlates with better results. Most traders discover their confidence has little correlation with outcomes, a humbling but valuable realization. Attribution bias leads us to attribute successes to skill and failures to bad luck. Won a trade? I'm a genius. Lost a trade? Market manipulation. This bias prevents genuine learning and improvement. Practice honest attribution. After each trade, identify factors within and outside your control. Did you win because of good analysis or favorable conditions? Did you lose due to poor execution or unavoidable market events? This balanced attribution accelerates learning. Here's a comprehensive bias checking routine to implement before each trading session. 1. Review your recent trades. Are you anchoring to any prices? 2. Check your analysis. Are you seeking confirming evidence only? 3. Assess your confidence. Is it justified by results or recency? 4. Examine your assumptions. What are you taking for granted? 5. Consider alternatives. What's the bear case to your bull thesis? Remember Daniel Kahneman's wisdom. The confidence people have in their beliefs is not a measure of the quality of evidence, but of the coherence of the story the mind has managed to construct. Markets don't care about your stories, they care about reality. Overcoming biases isn't a one-time achievement, it's an ongoing practice requiring constant vigilance. Even experienced traders fall prey to biases, especially during stress or success. The key is developing systems that check biases before they impact decisions. Building unbreakable trading discipline. Discipline separates professional traders from gamblers. It's the bridge between knowing what to do and actually doing it. Without discipline, the best strategy in the world becomes worthless. Let's build your discipline from the ground up. First, understand that discipline isn't about willpower. Willpower is finite and fails under pressure. True discipline comes from systems and habits that make right actions automatic. Think of discipline as a skill you develop, not a character trait you're born with. Linda Rashka, one of the most disciplined traders I've studied, follows a simple principle. I have a routine I follow every day. I don't deviate from it. Discipline is doing what you're supposed to do when you're supposed to do it, whether you feel like it or not. The foundation of trading discipline is a written trading plan. Not a mental plan, not a general idea, a detailed written document covering entry criteria, exactly what must align, position sizing rules, how much to risk, exit strategies, both stop loss and profit targets, time frames and trading hours, maximum daily, weekly loss limits, rules for breaking rules. Yes, even this needs planning. Here's the critical part. Your plan must be specific enough that another trader could execute it. Vague plans like buy support, sell resistance aren't plans. They're wishes. Specific plans say, enter long when price touches 20-day moving average with RSI below 30 and volume above average. Creating discipline requires what I call the 3 pillars system. Pillar 1, pre-trade discipline. This starts before market open. Successful traders don't randomly scan charts looking for opportunities. They follow systematic preparation routines. Develop a pre-market checklist. Review economic calendar for high-impact events. Check overnight market movements and news. Identify key support and resistance levels. Set alerts for potential trade setups. Review your trading plan and rules. Perform a mental state check. This routine creates mental preparation and prevents impulsive trading. When you've done your homework, you trade your plan instead of reacting to market noise. Pillar 2, in-trade discipline. This is where most traders fail. The market moves against them and suddenly their plan evaporates, or they see quick profits and abandon targets for just a bit more. Implement trade automation wherever possible. Use stop-loss orders, not mental stops, actual orders in the system. Set profit targets using limit orders. The less you need to make decisions during trades, the more disciplined you'll remain. When you must make discretionary decisions, use the STOP protocol. Stop what you're doing. Take 3 deep breaths. Observe your emotional state. Proceed with your plan. This simple protocol prevents emotional hijacking during critical moments. Pillar 3, post-trade discipline. What you do after trades determines future success. Most traders either celebrate wins or sulk over losses. Professionals analyze and learn. Maintain a detailed trading journal. Not just entries and exits, but what was your analysis? How did you feel before, during, and after? Did you follow your plan exactly? What would you do differently? Rate the trade quality 1 to 10 regardless of outcome. Here's a powerful discipline technique, the rule of 3. If you break your trading rules 3 times in a day, you're done trading. No exceptions. This creates real consequences for lack of discipline. Tom Baldwin, legendary pit trader, used physical discipline to maintain mental discipline. He'd arrive at the same time, stand in the same spot, follow the same routine. This physical consistency created mental consistency. Develop your own trading rituals that anchor discipline. Let's address the biggest discipline killer, revenge trading. After a loss, emotions demand you make it back. This leads to oversized positions, abandoned rules, and usually bigger losses. The antidote is the cool-down protocol. After any significant loss, step away for minimum 30 minutes. Perform physical exercise, even a short walk. Review what happened objectively. Remind yourself that one trade doesn't define you. Return only when emotionally neutral. Consistency comes from treating trading like a business, not a casino. Businesses have procedures, quality control, and performance reviews. Implement these in your trading. Weekly performance reviews. Every Friday, analyze your week. Calculate win rate, risk-reward ratios, and rule compliance rate. Identify patterns in your mistakes. Set specific goals for improvement next week. Monthly strategy audits. Review whether your strategy still fits market conditions. Markets evolve and strategies must adapt, but changes should be systematic. not emotional reactions to short-term results. Here's an advanced discipline technique: process scoring. Instead of focusing on profit/loss, score each day based on process compliance. Followed pre-market routine, 20 points. Took only qualified setups, 30 points. Honored all stops, 30 points. Completed trade journal, 20 points. Aim for 90 plus points daily. This shifts focus from outcomes, which you can't control, to process, which you can. Paradoxically, focusing on process improves outcomes. Remember, discipline is freedom. It frees you from emotional decisions, from market manipulation, from your own worst impulses. Every rule you follow, every plan you execute, builds the muscle of discipline. Start small if needed. Master one aspect of discipline before adding others. Maybe begin with always using stop losses. Once that's automatic, add position sizing rules. Build your discipline fortress one brick at a time. Your next steps to trading psychology mastery. If you've made it this far, congratulations. You've just absorbed what most traders spend years trying to figure out on their own. But here's the truth. Knowledge without action is just entertainment. So here's my challenge to you. Pick one technique from this video, just one, and implement it in your next trading session. Then come back and drop a comment telling me which technique you chose and how it affected your trading. I personally read every comment and love seeing your breakthroughs. If this video opened your eyes to what's really holding your trading back, do me a favor. Smash that like button. It tells YouTube this content is valuable and helps other traders find these game-changing insights. And if you're serious about mastering trading psychology, you need to subscribe and hit the notification bell. Every week, I break down the mental strategies that separate the 10% who profit from the 90% who don't. You don't want to miss what's coming next. Remember, the market will still be there tomorrow, but the trader you are today doesn't have to be. Every day, you get to choose. Trade with your emotions or trade with discipline. Which trader will you choose to be? I'll see you in the next video. Until then, stay disciplined, stay focused, and keep training that 6 inches between your ears. Trade smart, trade strong, trade with psychology on your side.